I've just been saying I have to say, admit, Kai, a lot when I get wrong, it's most important in a minute. I've been saying it too long. I think starting in 2019. To me, it's a matter of time it gets to 3,000, but I'm not going to put a time on it. But silver, I think the technicals were great. Once it got above 26, it signaled a breakout, and it gave you a dip back down to 26 and went up. I'm glad I don't trade it anymore, because if I did, I'd be messed up. If I just watch it and don't have a position on it, it works right. So now I think the next, it backs up. 30 is now support. Where it goes next, getting above 50 takes a while, but I think it's going to depend on gold. And the key risk I pointed out earlier is silver and copper have a much higher beta now to the stock market, U.S. stock market.
Gold prices saw an uptick on Friday as the dollar weakened, but they were still on track for their steepest weekly decline in over 5 months. After soaring to a record high of $2,449.89 on Monday, the precious metal plummeted by more than $100, marking a 3% drop this week, its worst performance since early December. While the gold market rebounded slightly from its near 2-week lows, robust activity in the U.S. manufacturing sector could exert downward pressure on gold prices as the Memorial Day long weekend approaches. Despite recent volatility, gold continues to attract market interest, underpinned by strong long-term potential. Bloomberg senior commodity strategist Mike McGlone has predicted a rise in gold prices to $3,000 since 2019, a milestone yet to be reached. Nonetheless, McGlone remains optimistic about gold's prospects, particularly given significant buying activity from central banks. Central banks, led by China, are purchasing substantial quantities of gold to diversify away from the US dollar, especially amid shifting geopolitical dynamics such as the strengthening relationship between China and Russia. Following this trend, the Reserve Bank of India increased its gold reserves by 24 tons in the first 4 months, compared to an additional 16 tons throughout the previous year. Looking ahead, McGlone anticipates a shift towards gold among U.S. investors, driven by a cooling stock market rally and reverting bond yields. This shift will be motivated by a quest for stability and diversification. Moreover, UBS has revised its gold price forecast upwards to $2,600 per ounce by the end of 2024, reflecting a bullish outlook on the metal's future. Over the past 5 years, gold has appreciated by 89%, slightly outperforming the S&P 500's 85% gain, further highlighting its value as a stable investment. Join us as we delve into Michael Oliver's insights. To stay updated with our latest uploads, subscribe to our channel and activate notifications. Thank you and enjoy the video.
I like the latter. I like to say, first of all, the deepest pockets on the planet are buying gold. Now, everybody knows this at the conference here, and that's the World Gold Council points out. The word they use for central banks buying gold, led by China, is colossal. Now, this is on the back of the unlimited friendship between President Xi and President Putin. To me, that shifted the world order. Its 2 major customers, China's is an export economy, are GMTFO. An acronym I learned in the trading pit, get me the heck out, of China. You can see it every day in the U.S. You see it in the election. There's competition between the 2 candidates, who can bash China the most. It gets votes. That's bad for China. Then there's a property crisis. What I think is happening in China is very similar to what Japan did in the peak in 1990. GDP in China right now, $4 trillion, is the same as it was 30 years ago. That's going to happen in China. It's going down that way. What stops that? So I look at this unlimited friendship started this tweak of buying gold as a backup, some way to get out of the dollar. It's the only alternative. There's a little Bitcoin in that space. The key thing that's significant for me, Kai, is during this period, since the peak in 2020, there's been about 100 million ounces total buying of gold, a little bit more from central banks. At the same time, ETF outflows have been about 30 million ounces. I mean, it's the most significant amount of ETF outflows in gold, from 110 million ounces to about 80 now, ever. And ETFs have been around for 10 years, with the gold price still going up. So here's what's going to happen, and no risk in making predictions. At some point, there's going to be a tilt towards buying gold from normal investors in the U.S. Right now, I'd like to say is why buy gold if you're a U.S. investor, most Western, when you can get the stock market's on a tear and you get 5% T-bills. Once that reverts, which will happen, it's a question of time, all that money starts flowing towards the rock. The key thing I like to end with is the rock stocks. I mean, the rock gold is beating stocks this year. So gold's up 17, 18% total return versus the S&P 500 total return around 12%. That's not a good sign for this AI-driven stock market. So I'm sticking with gold. I think and you look at the gold stock market ratio, it's really low. You look at the stock market GDP ratio, it's really high. Just a little normal reversion takes a spark. I don't know what the spark's going to be, but that's what I think is happening. And so I overlaid that with two ratios, gold versus silver. Every time we get the stock market that high, gold versus silver typically bottoms and then goes back up because the stock market mean reverts. And gold versus copper, same thing. So these are somewhat technical, but the fundamentals are serious. If you look at bond yields in China, all-time new lows. CGB yields, 10-year note yield in China is 2.3% or so. Our database goes back 18 years. That's 200 basis points less than the U.S. So from a bond yield standpoint, indications of really happened in the market, you see severe deflationary forces. So I think that to me is what I'm worried about, is this recent bounce in the more economic sensitive metals, which includes silver now, but copper, and gold's just hanging out. So by the end of the year, we should expect a pickup in U.S. volatility. Who knows what's going to happen with the election? And gold, I think, is going to be the more enduring performer. Now, if we don't get that, it'd be different this time. It's very rare for the stock market to just keep marching up higher when it gets this expensive.
Mike McGlone emphasizes the strong technical performance of silver, pointing out that $30 is emerging as a support level despite robust U.S. economic data suggesting prolonged higher interest rates and a strong dollar. Silver managed to recover from early losses, reaching an intraday high of $30.50. Often labeled the devil's metal due to its volatility, silver last peaked at around $50 in 2011. McGlone suggests that while silver has displayed strength, breaking past the $50 mark will hinge on gold's performance and broader economic conditions. The recent performance of silver underscores its resilience, even in the face of strong economic indicators that typically affect precious metals. Interestingly, the correlation between silver and copper has strengthened due to their extensive industrial applications, setting them apart from gold, which central banks primarily hoard. Silver and copper play essential roles in various industries, further boosting their demand. Institutional investors are increasingly taking positions in commodities, especially gold, copper, and silver, driven by high demand from both industrial sectors and retail investors. The manufacturing sector, in particular, is fueling the need for copper and silver, bridging a crucial gap in the market. Let's get back to the interview.
I think so. Well, gold's driving everything. I mean, silver to get it to an all-time high, it's got to go 50. I remember that in 2011. I was at S&P running commodities there. And a lot of us remember it. And it's known as the devil's metal for a reason. So if you overlay silver and copper, it's the correlation's increasing daily. Silver is more like copper now, and it makes sense. It's an industrial metal. Central banks are not buying silver. But the key thing that might be happening, I'm getting whiffs of this, don't know for sure, is if China is hoarding gold, which we know they are, and a lot of central banks are, why not silver and copper in that space? You don't hoard crude oil. Now they've rebuilt their SPR, their Strategic Petroleum Reserve, but the metals you can hold. And so one thing I love about the metals in a commodity space is Bloomberg indices, 2018 created the all metals index. And part of the reason is because I asked them to, because in commodities, over time, metals beat everything. Low elasticity of supply, increasing demand and adoption, and the whole decarbonization, electrification, digitalization trends always good for most. And then you got gold together. All the other commodities have that high price cure, and they're still under the headwind of that, like crude oil and everything. But silver, I think the technicals were great. Once it got above 26, it signaled it'd break out, and it gave you a dip back down to 26 and went up. I'm glad I don't trade it anymore, because if I did, I'd be messed up. If I just watch it and don't have a position on it, it works right. So now I think it backs up. 30 is now support. Where it goes next, getting above 50 takes a while, but I think it's going to depend on gold. And the key risk I pointed out earlier is silver and copper have a much higher beta now to the stock market, U.S. stock market. And by some measures, the U.S. stock market, in my view, is most expensive in 20 years. So here's something I published recently. Take the U.S. stock market, S&P 500, divide by GDP. Just add 2 zeros, and that ratio over time is about 1. I go back to 1928. Right now it's about 2. Okay, and the average is about 1. Same thing, I'll just take the S&P 500 divide by gold. The ratio over time is about 1. Now it depends if you go back pre-1971, before we went off the gold standard, but that is about 2.2. So versus, I mentioned this earlier, GDP, the stock market's very expensive, and versus gold, it's very expensive. But you put those two together, it's the most expensive in our database in 100 years. Just needs a spark for reversion. I think copper and silver are in the same bucket now. Silver's no longer in that bucket with gold anymore. It's much more industrial. And the way I see it is they're catching up to they're catching up, both copper and silver are catching up to gold and beta. So gold's been leading it, and gold is, to me, is the most enduring bull market in commodities. And that's not so profound because gold typically beats all commodities over time, particularly on a total return basis. But I see gold still as the best performing commodity this year. It's been backing up, well, not backing up, but it's been getting some catch up from silver and copper. The problem is we know silver's nicknamed the devil's metal for a reason. And when you see what's happened recently with the big spike in copper and silver, now new highs in copper, is I'm more worried about the autocorrelation factors. I mean, you don't want to, it's from a trader standpoint, you just don't want to lay into copper after it bounces like this. Now, let's look in the key levels I've been looking at. Once it broke above $4 a pound, straight to 5, new highs, 5.20 dollars a pound. But now the key thing I'm worried about is you look at managed money net positions on copper, i.e. hedge funds. They're very long. I mean, they've been on this trade, and they have itchy trigger fingers. I mean, they're not the kind of traders who want to drive a long-term enduring bull market. So I think the trigger will be, at some point they'll liquidate, make copper go down, and it's the macro that I'm really worried about, is copper is catching up to beta. And then I look at the stock market. You can overlay copper and the S&P 500. It's almost tick for tick. For almost 10 years, it got a little cheap. It's right back up, and they're 1-to-1 with S&P 500. And to me, the data I look at is the S&P 500 beta in the U.S. is about the most stretched I've seen it since actually 1999 and 2007. So very expensive beta.
Considering the recent fluctuations in gold prices and the upward trend in central banks' gold reserves, do you anticipate that gold will indeed hit Mike McGlone's projected $3,000 milestone in the foreseeable future? What key elements do you think will play the most significant role in driving this potential ascent? Feel free to share your insights in the comments section. If you found the video insightful, we invite you to join our community by subscribing to our channel and turning on notifications using the bell icon. Thank you for being a valued member of our community.